Great. So we've already got some people filing in.
This chat.
So welcome everybody who's joined already. We'll be getting started in a few minutes here. Okay, time is of the essence. We'll go ahead and get things kicked off as people start to file in. So I'm Michael Mazzarella with Whale, and today you are watching What's Your Business Really Worth Without You? We've got three wonderful speakers here with us today. So Sean Hutchinson, partner at Ready for Next, Shina Culberson, president at Quist Valuation, and Gary Vanbutsele, CEO at Whale. So, Sean, we'll start with you to get us kicked off today.
Sure. Hi, everyone. Thanks for attending. Today, we're going to really talk about some very important issues related to the value and transferability of a business that has a high degree of independence on the owner or on certain key people within the organization. I think that's an important thing to broaden the view. What would your business be worth if you, as the owner, weren't part of it? But also, what would your business be worth if certain key people who have a lot of knowledge and operational know-how, what would it be worth if they left the business? In other words, is the knowledge walking out the door with the people, or is it staying with the business? So we'll talk a little bit about valuation concepts, how this plays into killing value. I'll talk about 5 dimensions of owner dependency. We're going to have a conversation about this. This is not about individual presentations. You're not going to see slides. We're going to connect some of the key concepts here and hopefully leave you with a much clearer idea of how this discount on value around dependency actually shows up in the business. So, Shina, I want to turn it over to you first to lay the groundwork for valuation.
Great. Thanks, Sean. So let me start with this idea. So buyers don't buy revenue. So when you go to market, they're not buying revenue. What are they buying? They are buying confidence in your company's cash flow generating ability and that continue to generate that cash flow and profitability into the future when ownership changes. So they're not buying past earnings, they're buying future earnings. And anything that you can do within your business to ensure that the future earnings generating ability is predictable will increase the value of your company. So again, like Sean said, we're focusing in on two primary capitals that drive business value. So those capitals are what we're talking about today are structural capital. So those are your systems and processes within your business and human capital, your leadership and management. So why do owners confuse value with real company values? Sean and I have a lot of experience. A lot of owners mistake what they think the value is in their company based on just pure emotion, right? How much have you put into the business? How much effort, emotional, sweat equity have you put in? That doesn't always translate to future or to value that a buyer would pay for. So many of you may know, but 80% of all business value is tied to intangible drivers. So we talked about two of them that we're going to emphasize today: human capital, structural capital. The other two capitals are social capital, so brand and market positioning, and customer capital. But again, let's focus in on human capital and structural capital. So things that can lift value for your company or lift the multiple for your company is anything you could do to ensure recurring revenue. So diversified customer base, having contracted revenue, those are going to lift value. Having documented systems and processes, anything that helps that business become more transferable in its everyday operation after you sell the business, going to lift value. That second tier management, having a strong second tier management with delegated leadership takes the onus off the owner for that transition. That's a value driver. And then lastly, creating predictable and scalable growth. And again, having a future or potential buyer see that they can scale their own business by bringing in yours, those are all value drivers. They're going to lift the multiple. It seems obvious to say on the other side, value killers are things like single point of failure. This is probably, I'm sure Sean has a great story that he's going to share with you, but this is, in my experience, the single most common factor for value killer is that single point of failure. Saying it's all in my head, there's no documentation, not having a knowledge center across the organization that's going to help prevent the business from being able to scale. And then lastly, inconsistent financials or no forward-looking visibility for the company, which really takes a team to create that. Those can be real value killers. So I'm just going to stop with those high-level thoughts there, Sean, and let you kind of jump in with your thoughts.
Okay. So one key point that I think Shina brought up is we always encourage our owner clients to see the business through the eyes of a buyer. So this is an important shift, right? So it goes back to that. Sometimes we as owners, I'm an entrepreneur, I own a business. I'm also the third generation inheritor of a family business. It's about 67 years old. Interestingly, it's really dependent on my dad. He's my worst client, right? He won't take my advice. This is crazy. So this is what I do for a living, but I haven't been able to convince him at the age of 82 that we really need to operate the business more differently. We have started with a family board of directors and things like that. So that's been helpful. But see your business through the eyes of an investor starts to take some of that emotion out of the valuation, how the buyer is going to price the opportunity versus the idea of what the value of the company can be. So you can see how that shift can turn a light bulb on for you as an owner around how would I look at my business if I were actually about to write a check for it, right? To take that kind of future risk that I'm investing in. Now, when we're talking about owner dependency or key person dependency, there is a whole spectrum of risks that will drive the multiple down. And when we talk about multiple, we're talking about a multiple of earnings, right? So that stands in for EBITDA, earnings before interest, tax, depreciation, amortization. It's kind of a stand-in for cash flow, which is what Shina was talking about. And then the market is going to apply a range of multiples. Low is going to be not a very good business. And then on the high range, it's going to be best in class. The market kind of sets those ranges. It is possible for a business to really move the ceiling and break through it, but you got to do it really well. You got to be best in class or beyond. You got to be positioned. All those intangible capitals have to be in place. So everything that Shina was saying is really important to get a sense of what the ecosystem of value creation really looks like for a buyer. Now, I've been doing this a long time. I'm pretty good at what I do, but I don't learn very quickly because it took me about 20 years of practice to realize that there was one alpha risk, as in our terms, that a whole lot of other stuff dropped out of it. If you see owner dependency or key person dependency as the alpha risk and the discount against value, Shina, what would you say that is? It's a pretty shocking number for a lot of owners. Where would you put it?
Key man risk or owner dependency is the number one risk. And I think it can lower value by a minimum of 25%, maybe closer to 50%. It's
Yeah.
really about if you can't transfer a business to a buyer, I would question whether you actually have a sellable business.
Yeah. It could discount it 100% because you can't actually transfer it to somebody else. So you
Eh,
could
Yeah, sorry,
face a
Sean, to interrupt. And
situation.
there's, sorry to interrupt.
Yeah.
And I'm sure you'll get into it, but there's significant impact on the deal structure or the impact on the owner after the transaction. And I'm sure we'll get to that later.
Yeah, we could talk about that. So, Gary, you're going to talk about a process-driven business, which is a big piece of this, but there are other dimensions of dependency that I just want to mention. Then I'm going to tell you guys a story and we can get at this. Those dimensions of dependency that we've identified are there's obviously operational dependency when you're talking about process and documentation and that sort of structural capital, right? So that's operational dependency on the owner. Something happens to the owner, something happens to key people, knowledge walks out the door. Great, but a whole lot of deterioration in the business tanks the value, makes it potentially untransferable, could close its doors in its most dramatic form. So we don't want that to happen. In addition to operational dependency, decision dependency. Like if the owner is making all the important decisions and not really delegating that to other people, and there's a whole sort of brain thing happening where the decisions are being made a certain way and they're being made quickly, but only the owner has that decision logic or authority to make those decisions. And so the business is held back. Its growth is held back. A highly dependent business cannot scale or grow beyond a certain point. It just can't, right? There, it's going to hit a wall at some point. So decision dependency, relationship dependency. Who holds the major relationships in this business? Relationships with vendors, relationships with buyers, relationships with key strategic partners. We've run into so many situations where the owner, after 30 years, still owns the key customer relationships, even though they have a sales team, right? Even though it would be better for that sales team to actually take that over, the owner, because of a long relationship, probably still owns, if you will, all of that, right? And knowledge dependency, that's a big one. How is the brain operating? Goes back to decision, goes back to, but knowledge management is a huge piece of this. And a lot of companies don't do it very well. So you guys have heard the phrase and you've said it. My people are my most important asset. That actually means the knowledge that my people have, their ability to make good decisions quickly and achieve operational excellence has the most value in my business, but it never shows up as an asset on the balance sheet. This is what we mean by that intangible value. You can have the tangible fixed assets listed on the and valued, but it's the intangible stuff that counts the most. And it's where we really focus probably some of our time, but not a huge amount of time because it doesn't necessarily show up on the balance sheet itself, but it's going to show up in the valuation, the pricing, and the marketplace quite prominently. And then lastly, financial dependency. How much of the value of the business is tied up in the owner or certain key people, right? And even banking relationships and things like that. You can go beyond value in terms of financial dependency. So those are the five dimensions of dependency that we've identified. Let me tell you a quick story. This is a real client of ours, and it'll just demonstrate, I think, some of the things that are at stake. So this is a 67-year-old second generation family owned business. Legacy is important to them. It's in the commercial HVAC space, which is a very hot, attractive space for transactions, private equity, consolidations. There's a lot of activity here. So these businesses are attractive and they have value. The owner is not sleeping at night because he knows if something happens to him, then the business is really going to be impaired because they've never written anything down in 67 years, not a thing, right? So they know it, they operate well, they can teach their technicians how to do it, both in when they're in the office and also in the field. But if anybody walks out the door, they lose something. There's a chip in the armor, right? Just a chink there that they feel. And if the owner were to leave, there's a whole bunch of institutional knowledge there, in addition to cultural family legacy knowledge, right? And then they have a 42-year service manager who is now 71 and he's retiring in 2 years. He knows everything. The tech's calling 150 times a day, 200 emails. Everybody's got to go back to him in order to know how to do really important stuff. That's unnecessary, right? He knows that he can teach the people to do it and he really tries, but he's tied down in the office. So what do we need to do? We need to write things down, first of all, but written things help, but sometimes they're not the way that people really can remember things. I'm a visual person. So if you give me bullet points, I'm like, that's nice, but I can't remember it. If you give me a flow chart, something visual, or even better, a video of actually watching it be done, then that's great. So what did we do? We put everybody in meta glasses. When they went out into the field, they had a good microphone and they just talked their way through it. And out of that came a whole lot of know-how from the service manager. But consider the challenge. Nothing written down, 42 years service manager knowledge. We have 24 months to download 42 years of experience, combine that with the owner. That's a big lift. You can only do it with good tools. You can only do it with good process and understanding really what's going on in the business for owner dependency. Now, this is the end of the road for that family legacy. There are no more children to take that business over, right? So there won't be a third generation family business here. They could potentially own it passively and just not work in it. That's a possibility, but the chances are good that they're going to sell it. So they must start looking at it through the eyes of an investor now, even though they're probably 5, 6, 7, maybe even 10 years away from transferring it, selling it in the open market. But in the meantime, they can run the business better, grow it, make more money, have a better culture, and the owner doesn't have to wake up in the middle of the night feeling like just sweating that if something happens to him or his service manager, they may not be able to run the place. That's not where you want to be. So it doesn't take a huge amount of time to really get this process started. And Gary, you guys have had a lot of experience. You work with a lot of businesses who are really trying to make the transition, I think, from not a really process run business to something like that. That we have a lot of situations, and I don't know if you guys see it at Whale too, where family businesses grow more than they anticipated. They outgrow the way that they operate, and they still operate as a family business with very informal decision making. And then all of a sudden they're in their $20 million revenue. They didn't think that they were going to get that far, and they're overwhelmed with, oh, we don't know how to run that kind of business. So they have to play catch up. And that's hard, but it's doable. So
It's
what are you seeing?
yeah, it's funny because we've worked with thousands of companies by now, all realizing that being owner dependent or key person dependent obviously it's not a good idea. And we've seen that in ranges with companies doing 1 million in revenue upwards to a few hundred millions in revenue. And sometimes I wonder how you get to 400 million in revenue and don't have any documented processes, but it is possible. I do wonder though, and I wanted to pass this question back to you, Shina and Sean, is when we talk to our customers and potential customers about the rationale of documenting processes and having more of a system-based company than an owner-dependent one, rationally, everyone agrees it's a better choice. However, so many companies and owners and leadership team members don't get there. Why is that, do you think? We know it keeps getting pushed off of the priority list for a myriad of reasons. What has been the top 2, 3 reasons you've heard over and over again?
Yeah, in my experience, nobody starts a company because they enjoy documenting procedures, right? Entrepreneurs love creating products. They love closing the next big deal. They love building companies where their employees enjoy going to every single day. So just out of the gate, documenting systems and processes, creating rules and job roles and responsibilities and document that is just not why anybody starts a business. We work with clients on an annual basis doing valuations for them, and every year we ask, okay, what's the process you've done? What process have you, or what progress have you made in document systems processes? And ultimately, the question back to me is, okay, Shina, I'm so tired of you asking me this question if I do this, how much more value you're going to give me for my company? It's like, what are you going to give me? Well, actually, the answer is a lot of additional value, a lot of additional value if you can get this done. Because again, when we think about perceived value, it's really in it's in, can the leadership team and the company execute on the strategy that they set? And do they have a history of executing on those goals and objectives? So it all comes down to that sort of execution and lowering execution risk. So, but that would be my experience. What about you, Sean?
So I'll add a couple of things to that. I totally agree. One key point here is there are three ways to increase the value of business. Increase the earnings, which is pretty straightforward, right? You can drive sales, everybody loves it, lower your cost. That's a little, it's like that's not as much fun, but okay. But you can pull levers on cost of goods, cost of services, so on and so forth, and be really efficient with your cash flow. Great. The area of risk reduction, if I were to put on an 8.5 by 11 sheet piece of paper the segments of increase earnings, reduce risk, and really position your company, that social capital, as a valuable company, as a best in class company, those are the three ways. It would be an inch at the top for increased earnings. It would be about 6 inches of reduced risk and another inch at the bottom of how to position the company as best in class and communicate that to the marketplace. Unfortunately, it's that the risk has, in my opinion, the outsized impact on value. You can increase earnings all day long. At the same time, you can be introducing more risk. You can be concentrating your revenue in one or two customers because you chased whales. You can be not really keeping key people. Knowledge is walking out the doors. We're talking about all those things are discounting value most likely quicker than you can add earnings and profit, right? Your cash flow maybe. So reducing risk is gritty work. It's like spade work. It's like digging in hard ground at the beginning, right? You're like, okay, this isn't any fun. It's exhausting. I see the results, but I'm not loving it. So let's go sell stuff. That's more fun. Okay, so there's that. Totally agree with that. But you got to ask yourself, if I've got a $20 million enterprise value business and the valuer is saying, look, it's all this value is concentrated in a few people in the organization. They haven't written anything down or not much. And people are 5 different versions of the same process circulating in the business. And nobody knows which one is right. They just do whatever it is that they want. That at the end of the day, you might be giving up 5, 6, $10 million worth of value in the marketplace. Are you willing to invest $1 million worth of human and structural capital to get that 10 million back and more? I don't know of another investment that you could put maybe a year or 2 years worth of work into and make a lot of progress that'll return, that has that higher return on investment, right? And you're in control of it. If you invest in the equity market, you're not as much as in control. And entrepreneurs really like to be in control of their financial future. Now, there's another reason that I think people struggle with, let's say, owners and even key people. When you start the business or you're growing the business, it feels good in a way for people to rely on you. You feel relevant, you feel powerful, you feel authoritative. People are coming to you, asking you to make important decisions, to give them information, right? That feels good to any human. It feels good. When you say something like, okay, in order to really drive value, I need to make myself dispensable, right? I need to make myself less relevant. That kind of works against our human impulse to be in there, right? So, to a certain extent, I think owners and key people can be threatened by writing stuff down and creating a process-driven company because they're moving their brain into something and then they say, why am I needed if all that stuff is downloaded? And I think that actually is a barrier that we have to acknowledge. It's very human. You can't just spin past it and say, that's silly. It's real. So, how are we going to help people get past that hurdle? The transactional aspect, oh, it's going to make the business more valuable and more transferable. And that's important to me because I need the money for retirement and so on and so forth. There is that. But I also think there's this change management aspect to it, which we sometimes underemphasize, because this is a massive transformational difference between the way the company is run today versus the way it will be run in the future. Now, does the I'm waking up at night in a cold sweat influence that? Yes, because nobody wants to feel that way. So there's a balancing, like, I don't want to, that's not the life I want to live. And I have to say, I'm going to say that this might be an ouch for some of the folks that are on, depending on your situation. If you are running if you've been running, if you created and been running a 30-year-old business that's still dependent on you, that's a choice, right? You, at some point along the way, you've convinced yourself that's okay, and that might be an emotional decision. But from a value creation transferability standpoint, that's a killer. So you have to figure out whether you want that. And then it's got to be intentional, incremental change to make sure that you don't end up in the wrong place. I think it comes as a shock, actually, Shina, to most owners when they say, hey, the business, I've got a lot of know-how and I know that the buyer is going to appreciate that. And you say, yeah, but if it's dependent on you, take 50% off that number. It's like, how can that possibly be the case? But that's the market reality. Absolutely.
Yeah, I think it's worth just revisiting a illustration that you just gave, because I think it speaks to how we approach kind of clients and thinking through when we work with them, which is, first, we approach the client from a position of, let's protect the value that you've already created in your business before we move on to addressing how to create value by scaling your business. So, Sean, you gave the illustration a moment ago of, if you had a $10 million company, wouldn't you want to invest a relatively small amount of $1 million, let's say, to improve the human capital, the structural capital of your organization? And that is the concept is, it takes an incremental lower investment to protect value, because once you move towards scaling, the investment dollars are inherently just much larger. So if you think about scaling, you might be thinking about expanding locations, or maybe doing a strategic acquisition of your own to enter a new market or bring on a new product or bring on a new service. So that scaling piece is just exponentially more expensive than protecting the value that you have. So to not waste those dollars, really the approach that we have is protect what you have first, invest a relatively smaller investment in that protection phase, make sure the business can execute, its knowledge is transferable, decision making is dispersed, and then you move on to that scaling piece that is inherently much riskier and requires greater dollars.
Yeah. Yeah. I think risk,
I
we've always viewed this level of risk as friction in the business, right? So when you reduce the friction, then I'll give you a picture. If you think about your business as a rocket sitting on the pad, right? Then it takes a lot of fuel to get it off. It's high gravity, right? It takes a lot of fuel to launch it. And if you've got a high degree of risk, it just keeps getting slammed back on the pad, right? And eventually you just run out of energy and capital and fuel because you just haven't created the conditions for success. But if you can get it off the pad and up into the lighter parts of the atmosphere, then you're going to get to escape velocity eventually, where you can make those efficient capital fuel investments in growth and scaling in the future, right? So you actually do become more efficient. You have less risk. Eventually, you may get into the white spaces of the market where really nobody else is there, and you can take full advantage of the way that you have prepared for succeeding in that marketplace. So we always say, don't be the business that just keeps being slammed back down on the pad because you didn't do the work of risk reduction first, right?
yeah,
And that slamming
I
back down on the pad, by the way, is not just difficulty, it's also value being taken out of the business. Because every time the rocket gets slammed back down, see it as a value discount.
the biggest misconception that we see, and I feel that this resonates in this conversation as well, is that it's not the most fun thing to do, obviously, like getting your systems
Yeah.
written down and transferred. It's obviously for an entrepreneur, not the thing you're leaping out of bed for. And one of the reasons I think that is because it tends to be seen as this huge amount of work, which will need a lot of your attention and resources and time. And I'd say that'd be true about 6 or 7 years ago. The reality today with technology like we provide, it's become much easier, not just through the technology though, but also because people overestimate what they need to document to make an impact. And this is one of the methodologies that we keep on sharing with our clients as well, is that if you focus on the low effort, high impact items, the things that are broken now, the things that people keep calling mark for every single day, 7 times a day, if you fix those today, which could be as little time as 3 minutes, to just be like, hey, you know what? Let me capture how I do this once, put it somewhere everyone can access, and this is no longer something I'll need to reply to. If you do even one of those once a week, you do that consistently for a year, those are 52 things that you fix throughout a year. And documenting one thing a week is not a very high bar to set. And if you do that with multiple
Right.
people, you will get there. I love that story of we need to transfer 42 years of experience in 24 months. Sean, we've seen clients dump like collectively hundreds of years of knowledge in about 3 weeks' time because people set their
Yeah.
minds to it, they use the right tools, and they decide that
Yeah.
this is high value systems. These are the things that now are going rogue and we need to fix. And I feel like the key term here that's been passed around is ultimately predictability, right? That's what you need if you want to sell your business at a high valuation. And I've lived through a sale. I actually overlapped. We were building Whale and I sold my previous business. And I can attest to getting higher valuation because you've got your processes documented. And it's not just because of owner dependencies. There's a lot of like sub layers as to why it becomes more valuable. And one of the things that the company who bought us shared with us was there's so much ease in buying a company that has everything written down. The first thing was we
Yeah.
completely knew what the disjointment was with your process and ours. So when we bought you, we know here's where we're doing things differently, and here's how we think we can do better, and here is stuff that we can learn from you guys. So they immediately
Yeah.
saw the things that they needed to fix and the things that they could take over and improve in their own business. The second thing
Yeah.
was they were not worried with how we, when there were some turnover or we had new employees joining, they were not worried about the sunken cost of a very long ramp up time because we could predict and show that, okay, in 3 weeks, our new hires are ready to be ramped up. It
Yeah.
was amazing to them because they were a high growth company. They wanted to keep growing. They were like, this is awesome. We can get people ramped up very quickly. The fact that senior staff is not just putting out fires, but is busy with strategic work has its value. There's so many underlying things to system
Hmm.
documentation. And to your point, not just when you sell your business, but while you're in your business. I love that idea of working on the business before you scale. China, obviously the majority of the clients that use Whale are not just purchasing Whale to then sell at a higher valuation. The
Right.
majority is there to improve operational efficiencies today. And it touches everyone. It touches the owner that can probably sleep better at night. It touches leadership because they're not repeating themselves hundreds of times a week, and it touches new hires and existing staff because they now have a reliable way to find the information that will allow them to excel at their jobs and feel confident and feel supported. And ultimately, it lifts everyone up. It lifts people up. It lifts the business up. And I think that's the true value of a solution like Whale and a service that we offer. It's that predictability for everyone. So again, not seeing this as this huge mountain to overcome, but as something small you can chip away at and improve day by day or week by week is how we've seen businesses transform in record times. It's been amazing to
Yeah.
watch.
Yeah. I would add that one advantage that we've seen of folks really focusing incrementally on this is one, they do get better at it over time, right? In the beginning, it's, "Oh, I don't really know how to do that, but I'll take a shot
Mhm.
at it." And then they do, and they're like, that wasn't too bad. Let me try it again. And then they just get faster and better. But I
Right.
also think the we have to respect that people learn and absorb information in various forms. One of the things that I like about Whale is it accommodates the written version of the SOP, the flowchart version, the screen capture version, the video version that can use AI to sort of fit up really quickly and caption it. So I like all of those things because it just makes it more robust for folks,
Right.
right? And then the other thing that we see is as people write stuff down, one, it gives them an opportunity to say, why exactly are we doing it that way, right? It seems like it's got too many steps. I don't think we have that. I don't think we need to do that. Maybe we can eliminate some stuff because they're not
Mhm.
value added activities. They're not changing form and function in the next stage. They're just one more step. Why did we do that?
Mhm.
Oh, the last person did it that way and they taught us and we
Mhm.
never really thought about it. So everybody's doing it in an efficient way. So it helps with ideation and efficiency. And I think that there's a sense of agency when people are working on processes and someone has said, don't just document it, we give you permission to make it better. Then they're, oh, that's a really great invitation to look into it, give it a good look, a good x-ray, and determine once and for all, is this really the best way to do it? I also think that one of the things that plagues organizations, and big ones and small ones, is that they forget that SOPs need to be reviewed and updated periodically, right?
Mhm.
There are new tools and new ways of doing things and new practices. So remember, improvement is one thing. Getting the best in class is really what you want to do for that spectacular valuation and potential transfer. But in the, I forget what I was going to say, but it's this idea, I think, of continuous improvement, continuous review, and also making sure that when you update something, there is a single source of truth where you can say, there are not 5 versions of this. The updated version is the one that we have adopted. Here's some training so that you can come up to speed on it. And we don't have 5 different versions of this thing sitting on 5
Mhm.
different servers. No one really knows, is this the one I'm supposed to use or have they updated it? All of that stuff matters, right? And organizations struggle with versioning and adoption and training and all kinds of things. So writing it
Yeah.
is the first part. And
Yeah.
then,
And
okay, are actually people using it in the way that we intended? Is the outcome good?
honestly, creating the documentation has become the easiest part. There's technology has helped our customers so much. It's as easy as let me grab my smartphone, show me how it's done, and this can be in the field, or you just point your screen recording to whatever software that you use, and we will do all the work for you. So the heavy lifting is being done in that area. And there's other tools and ours out there. I would say the real big challenge that we help solve is that accessibility to the right information at the right time, Sean. And I do agree that it needs to be a bottom-up approach when you create documents, because Mark, who's been around for 30 years and is your senior engineer, has so much valuable work. It does not necessarily need to be its team lead that is writing all this stuff down. Let everyone
Yeah.
collaborate and let it be a bottom-up approach. But the accessibility piece is where it succeeds or it fails, because you can have 150 videos and 300 documents sitting in a SharePoint or a Google Drive somewhere. If nobody's going to go and look for them or doesn't know or is spending too much time or losing time digging through endless folders, it's not helping anyone. Might help a little bit with evaluation when you sell, because you can go, here are all my documents, go figure it out. But people will not be aligned with processes and it will still be an inefficient business. So the
Yeah.
accessibility piece, making it the easiest way for people to access information is where you're going to see real gains. And again, we've developed a lot of different ways for information to be connected to the right person at the right time. But if you're thinking about working on this side of the business, that is the biggest challenge to solve. It's not writing, because you can ask ChatGPT tomorrow to go and write you 20 SOPs in 5 seconds. So it's making
Yeah.
it valuable to the people in the right time.
Yeah.
Yeah, I'll say this is a related thought in terms of a common question that we're getting these days. from business owners and companies about the impact of AI in their business. So how do we view AI as a value driver, or how do we perceive that? So I think that historically we thought about documenting systems and processes from the framework of doing so will help the doing, the executing, and managing of time. With AI, the shift from a valuation perspective is how is this impacting the directing, the deciding, and the managing of workflows? It's a slight shift. So doing, executing, managing time to directing, deciding, managing flow. And you really need, in order to leverage the AI for internal efficiencies, you really need that documented systems and processes so you can shift the framework and shift the way that you talk about value within the organization. That's how we're starting to think about it, because I get this question all the time. How are you thinking about AI? But it really, Gary, to your point, it goes into that you have to have the basic systems and documents all kind of documented first and know where it is, so you can shift that mindset and shift the framework of how you use that once companies start leveraging AI in their business.
Yeah, that's interesting. That's such a hot topic. Like, how is that going to play out in valuation? Obviously, efficiency, acceleration, the trust levels in AI are all over the place, but I'm a positive. I'm an AI optimist. I look at a lot of business transformation. It is a tool. It's an unavoidable tool, first of all. So you got to learn how to use it. But if you deploy it well, there's plenty of evidence already that those businesses can become much more valuable than peer businesses. It is a best in class feature already, right? But it's not just a kind of thing on the watch list anymore. It's how are you going to use
Right.
this in your business to drive value, and lots of different applications of that. So one thing that you were saying, Gary, I just want to go back to, because change management has become a significant part of our practice. It really is a layer of all the implementations that we do now, because that's adoption, right? That it represents not just the way we've been doing things, which documentation may capture it, and that's great. But the change is the broad adoption of it within the organization and continuing to use it and improvement over a period of time. So that in the change management world, there are several models, but there's one called ADKAR. That's the acronym for it. And it starts with, it's a left to right kind of thing. You don't skip steps. So people are aware of whatever it is that they're supposed to do. They have the desire to do it that way, right? Then they have the knowledge, in other words, access to the information that they may need. Then they have the ability to actually apply it, because you can teach them how to do it all day long, but if they don't have the technical training to actually execute on it, then the ability simply isn't there. And then finally, and I think super importantly, the reinforcement stage of change. And a lot of organizations don't reinforce, reward, whatever it might look like. And every organization has a different version of that. I think there are lots of them, but reinforcing that kind of behavior and adoption is super important. There are a lot of folks who have the awareness and the desire. They miss the knowledge, they don't have the ability, and no one bothers to reinforce it once they get there. And so they stop at some point in that progression, and it's very individual. That's called the barrier point, when they stop. And you have to figure out a way to jump the hurdle, right, into whatever the barrier point is, whether it's desire, knowledge, ability, or reinforcement, or even awareness. You've got to learn how to move through that spectrum. Otherwise, the principle of change management is it's not the company that's changing, it's the individuals that change. And that adds up to company broad adoption and change. So if individuals don't follow the process or whatever it is that we're trying to get them to do in a way that isn't dependent on just a few people, They have to have the tools and they have to decide incrementally to get to wherever the organization needs to get them to, whether it's a project outcome, culture, intangible capital improvement, whatever it might be. So I really want to emphasize that we can do the work, the tools are there, they're enabling tools, AI being one of them, whale tools being another. But at the end of the day, if adoption is missing, it's an indication that we haven't managed change well.
Michael here, just from a timekeeping perspective, I do want to make sure that we get to some of the questions that have accumulated here. Already two people asking kind of a similar question, timing. So how far ahead of a desired acquisition or desired merger should people be looking at something like this? And I think that's to you, Sean, or you, Shina, from your own experiences.
Yeah. Shiny, go ahead. We probably have the same opinion on it, but
My answer is as early as possible, because this isn't just something that you do 12 months ahead of a sale or a transaction. This is really something that you do to grow value over time. And I guess understanding that nothing happens overnight, it takes time, it's an ongoing process. I would say you start
early
immediately.
as possible. Yeah.
Yeah.
Rule of thumb on value building, I think, prior to transition of some sort, certainly open market transition, third party private equity, anything like that, would be start at least 3 to 5 years in advance and really take it incrementally. Don't try to rush it at the end. The reason for that is not just it takes time to do it well. I think that's a big part of it. But I also think from a buyer's perspective, when you're looking for predictability in any way that you can get it, you have to, it has to be proven, right? So there has to be a kind of seasoning in there. Yeah, we have a strategy now. When did you put that strategy in place? About 6 months ago, in anticipation of some type of transition, right? Okay, good. We're glad you have a strategy, but we don't know if it's going to work yet because you did it 6 months ago. So we need 2 or 3 years. If I'm the buyer, I'm looking back probably 2 or 3 years and looking forward into what are the future benefit streams that I'm going to be able to access as a result of that prior work. So I need to see some seasoning, some proving before I'm going to say, okay, I'm going to put that in the valuation metric. That company did the work early. That's more attractive than the one that's just starting to do it. So if I have a choice of where I'm going to write a check, even though I might have to pay more for this other company over here, my upside is greater and it's going to be less of a pain. To go back to your point, Gary, I'm going to be able to see into it and go, okay, this is pretty easy to see how this is going to integrate. It's more stable, so on and so forth. It's got scaling and growth capability. I can do that. Private equity groups would be all over those kinds of businesses because they're not really discount buyers. They'll drive a hard bargain, but they're looking for good opportunities that they can scale. And a broken company with no processes isn't going to qualify. They'll throw that one in the trash pretty quickly.
Yeah, and that kind of touches on one of these questions here. Basically, and I'm paraphrasing, it's evidence. So maybe Gary, to your own experience with going through an acquisition, what were the things maybe that surprised you that they were looking for concrete evidence as opposed to the owner's word? And maybe China, if you have any experiences of where an owner was shocked that their own word wasn't enough, I think that kind of plays in that question as well.
Yes, there's obviously a few things. In our case, it was a strategic buyer, so they weren't looking to just fold us into a big portfolio of other companies. They were buying us for a myriad of reasons. One of the things that I think a lot of people undervalue or don't think about as much when it comes to strategic buying is, and they told us this repeatedly, why they were so interested in purchasing us at the time was culture fit. Ultimately, you're buying not just a company or processes, you're folding in people as well into a bigger organization, and they want to ensure that the day after tomorrow, once the sale has been closed and done, people are not just leaving left and right. And so culture fit was repeatedly being assessed as being one of the top things they were looking at. Is this really the same way from a high level perspective, from a value and from kind of North Star, how you handle yourselves as a team and as individuals, is this going to match? I think this is probably a topic for a completely different webinar, but values and systems have a lot in common as well. Not a lot of people
Mhm.
see it that way, but the way you orchestrate things do connect to values as well. So I think that going on in my previous company is again what drove a higher valuation than most in our industry back in the day.
Yeah.
So we've been talking a lot about it all comes down to execution risk. And anytime that you can decrease the perceived execution risk of your business, you're going to drive a higher value, a higher multiple, a lower discount rate for your business. Obviously, as being part of a valuation firm, we're really interested in numbers. The number one, Michael, to your point, the number one thing that we ask for that you'd be surprised we don't often get it is a budget and a forecast. You would think every company would have at least a current year budget and
Mhm.
hopefully a forecast. And we don't ask for those things because we're asking you to look into a crystal ball and make up numbers. The whole impetus around asking for something like that is that you thought about your business from a strategic perspective. You thought about the operational capabilities and requirements. You thought about your market dynamics and competitive position. You thought about your infrastructure to execute. And so that's the whole reason why we ask for projections, not to for the business owner to make up numbers. So, Michael, to your point, yes, business owners will come in, oh, we're going to grow 10%, 15%. How? Have you documented it? Do you have the supporting evidence for that? And the more businesses have their strategic plan, they've got their operational initiatives, it's tied to their forecasts and projections. The more you demonstrate that you have hit the mark year after year, your value is going to skyrocket because everybody can
Yeah.
see, I see how these things are all tied together. You've
Yeah.
executed, or even if you've missed where you've missed, you've been able to pivot and react in a act in a proactive manner, not a reactive manner. And that is all things that drive value higher. And so it's always a very interesting conversation for us as valuation experts when we get to this conversation about projections, because again, many owners think, oh, we're asking them to make up numbers. That's not the point of it. It really gives
Yeah.
us immediate sense of how deep they've thought about their business.
I would add to this that I think it's a little bit shocking for some owners, and I'll put it within the context of an actual acquisition process. So Gary, you've been through this and you know how this goes. But sometimes if I'm going in and buying a business, I'm gonna talk to the owner first. They may have an investment banker and M&A advisors running the deal. Maybe I'm getting a teaser and I'm signing a confidentiality agreement, and they're starting to share some information with me preliminarily, and then I'm going to decide whether I need a little bit more. But eventually, I'm going to put a letter of intent together, which is going to be pretty detailed, and we're going to have a really fairly deep negotiation over the terms in that. Right? All of this is probably with the owner and their advisors at this point, right? So I'm having a confidential conversation. But when we agree on the terms in that LOI, we're moving into what's called confirmatory due diligence, which is much, much deeper. And for most owners, a nightmare because they're not prepared for it and they don't understand exactly how invasive that's going to be and what they're going to be questioned over and how they're going to feel. Most people get fatigued as they're going through it. It's not a pleasant process. I try to communicate with our owners, this is what this thing is going to feel like. And they think, oh, it's not going to be that bad. And then they come back to me later and go, I wish I'd listened. So at the end of the day, though, I am at some point going to say to the owner, I'm not really buying you. I'm buying your leadership team and your processes and your execution proof, right? All of those things. I don't now I need to talk to your leadership team. And for a lot of owners, it's, oh, I didn't realize you're going to want to talk to my leadership team. And I'm like, yeah, of course I want to talk to them because I'm buying into them, right? I'm buying their leadership capability, not your leadership capability. My assumption is you're going to be gone in 6 months or a year or whatever. It's good that you're going to stay around a while, but that's all about just trying to transfer knowledge so it's not walking out the door with you. So the more prepared we are for that, the better. That goes quickly. And not only do I want to talk to your leadership team, I want to do what are called isolation interviews, where I talk privately with the CFO and the COO and director of X and sales VP alone. And what I'm looking for is differences I'm going to ask the same question of everybody, and they're going to have to prove to me that they all see it the same way. Can they articulate the strategy, right? Can they defend the projections? Do they understand them? Or are we seeing big disconnects at the leadership level in all of these really important issues? Can they talk about the company in the same way? Do they believe it? So for a lot of owners, they're, oh, I didn't know that this was actually going to take place. And it's a shock to them that I'm going to say, I'm not buying you. There's a point at which this conversation between us is just purely transactional. The rest of it for me is going to be, do I believe in the people who are going to be running this company in the future? Right.
Yeah.
And I think a lot of owners are just surprised by that,
And
honestly.
that is kind of the cliche that people live under, is that, oh, we're buying you, we're buying the vision, things like that. And I think in practice it doesn't turn out to be correct. So this last question times up nicely. It's actually for me, and it's, will this be recorded? And the definitive answer to that is yes. We will send out a recording to the attendees. I want to thank Sean, Shina, and Gary so much for attending, and I'd like to thank everybody here who attended this webinar. It's been a pleasure to put on.